Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. This is our weekly live Q&A. So as folks, I can see folks are already in the chat, but if you can just let me know if you can hear me, that would be fantastic. And while you're doing that, I'm just going to assume you can hear me and see me. I guess hearing me is probably more important than seeing me. I don't know. Actually, people might say the opposite. In any event, couple of quick things before we get into this. I'm really excited about today's topic before we get to the Q&A in the chat. Dave Ramsey's portfolio versus sort of a low-cost index fund portfolio. We're going to look at it in some detail. And a couple of things. If you're new to the chat, you're watching live, or you watch this video after the live stream is over. I do a live Q&A every week. I try to do it every Thursday at 11 a.m. Eastern time. I can tell you that's probably going to change from time to time. What I will do is schedule it in YouTube in advance, if at least a couple of hours, but hopefully at least a day. So if you subscribe to the channel and if you hit that bell for a reminder, you'll get notified when I'm going to go live. And it's an opportunity to, dialogue with you guys. You guys can ask me questions, ask me about certain topics, money and investing primarily, but I'll take fitness and nutrition and chess questions too. The second thing is in the chat, if you want to ask me a question or have me talk about a topic, put the @ symbol and then my name, right? So you direct it at me because it lights up orange in my chat stream and I can just go right to those. So if I don't see that, I'm likely going to skip over your question. So make sure you tag me in the chat when you have a question. So with that, I want to get right to the main topic. And it comes from a viewer named Patrick. Let me read you part of Patrick's email that he sent me the other day. Rob, thanks so much for the work you put into the channel. This week, I saw someone rail against Dave Ramsey a little about low-cost ETFs versus actively managed mutual funds. Basically, the caller was telling Ramsey he shouldn't recommend mutual funds instead of low-cost ETFs. Let me just stop there. A lot of times you'll hear people say ETFs versus mutual funds or low-cost ETFs versus mutual funds. The way you want to think about it is low-cost ETFs versus, I would say, actively managed mutual funds, because there are index mutual funds that are low cost. And like if you look at Vanguard or Fidelity or Schwab, well, Vanguard and Fidelity for sure, their index mutual funds are virtually identical to their index ETFs. Not always literally identical, but for all practical purposes, identical. Okay, Patrick has now, I've been using low-cost ETFs, and he mentioned several from Vanguard that we've talked about in the past. He said, I too have subscribed to, not wasting money on high expense ratio funds and ETFs, which after watching your videos, I'd venture to say you are a proponent of low-cost funds, and I absolutely am. Anyway, during the call, Dave kept fairly cool and said he thinks that with wise choices, you can beat the market. And that got Patrick to thinking. He said, well, I'm going to use some of the tools that Rob uses on the YouTube channel, like Portfolio Visualizer, and I'm going to test this out. And he was kind of surprised to find out that at least based on the tests he ran, Dave's portfolio did better than low-cost ETFs, low-cost index funds. And so he basically wanted to know, did I do it wrong somehow? Or is Dave right? Is he lucky? Is he smart? So we're going to look at it. So what we're going to do today, I'm going to first just briefly describe Dave's investment philosophy as I understand it. That's one. Then we're going to look at the portfolio that Patrick sent me. And then I'm going to show you a Dave Ramsey portfolio that I created myself, and I'll walk through how I did it. So that's what we're going to do. So to start with, and this should be below the video, links to this. If it's not, I'll put them there after the live stream. But here is a page, let me make it a little bigger. This is from Dave Ramsey's website, where he talks about his approach, Dave's investing philosophy. And there are basically a couple of things to it. I'm going to skip down to really the good stuff. He's a big proponent of mutual funds. We'll look at specifically what kind. He doesn't recommend ETFs, for example. Not a fan of ETFs. He's not a fan of REITs. He's not a fan of basically income investments. I'll just sort of summarize it. Bonds, fixed annuities. You can see them there. The CDs. He is a 100% stock investor. All right. Now, I'll just say this on that point. If you've got a long time to retirement, I think one can justifiably make the argument that that's a reasonable approach to investing. I believe Dave kind of used that as his approach, you know, regardless of where you are in your life's journey. That gives me some concern in retirement, because if you really need like 4 or 5% of your portfolio a year, adjusted for inflation to live on, and we hit a 1929 to 1932, and admittedly the odds of that are not great, but it's happened before. Even in that time period where there was deflation, right? The prices went down for a number of years. You're going to be hurting. I mean, the stocks lost 90%. So that's my one big concern about a 100% stock portfolio. But in any event, that's Dave's approach. All right, good. Let's go back to his article. And the one thing I want to show you, he just talks about some of these specific investments types, and you can read that if you like. Again, link below the video. Here's his basic approach right here. He wants 4 kinds of investments, and all mutual funds: growth and income, aggressive growth, and international. And one could sort of, well, I'll try my best to define these. So growth, I think, is fairly straightforward. It's mutual funds that invest in companies that are going to grow their earnings and grow their revenue faster than average. Growth and income is kind of, I wouldn't call it a balanced fund, but it's kind of a fund that is trying to get growth, as we just defined it, but also in a way that produces more income than a pure growth mutual fund. And income, I mean dividends. And to the extent it invested in bonds, Dave wouldn't approve of that, but to the extent it did, interest. But from Dave's perspective, it would be, you can imagine this being a growth fund, but it's tilted towards growth stocks that pay dividends. Okay. Now, aggressive growth, it's like, boy, there's a lot of growth going on in here. I mean, it's like, I don't want just growth. Who wants growth? I want aggressive growth. I wonder if he could pick very aggressive growth. Anyway, some sort of attribute that to like small cap growth funds. Fair enough, that's fine. So that's aggressive growth. I make a little fun of that. I don't know. Maybe that's a term. I've never heard that term outside of Dave Ramsey, but maybe it's a term in the industry. And then his fourth one is international. All right. So that's his sort of portfolio. And he kind of views it as, you can see it here, he divides right here. Dave divides his mutual fund equally, his mutual fund investments equally between each of these. So we'll see in a minute, the portfolio that Patrick sent me is not divided equally, but we'll look at his portfolio, his Dave Ramsey portfolio, and then I'm going to show you one that is equally divided. Now, before we look at the portfolio, I'm going to look at it in Portfolio Visualizer. We got to cover one important issue. Dave is a big believer in not investing on your own. He believes we need help. We're just like we hire a plumber, most of us probably, to come fix our hot water heater when it goes out. He believes we need help with investing. And when you get help, there's basically 2 types of help. You can get someone that you pay, right? You hire someone and you're going to pay them out of your own pocket, whether that's a flat fee, it could be an hourly fee, it could be a percentage of the investments they manage for you. That's called assets under management, AUM. However it's structured, you're paying the advisor, right? Another way would be you don't pay them anything, right? So how do they get compensated? They get paid from the investments they put you in. So if they put you in mutual fund number 1, whatever, it's that mutual fund company that's going to pay them. All right. Now, with someone you pay, they're typically an investment advisor, and they're what's called a fiduciary. They have to put your interests ahead of their own. And you might think, well, I sure hope that's what they do. Are you telling me there's investment help where they don't put my interests ahead of theirs? Yes, there is actually. It's the other bucket. They're not fiduciaries. They are salespeople. They're commissioned brokers. Now, that doesn't mean it's the wild, wild west and they can do whatever they want. They can't rip you off. And they have to make sure that the investments they're putting you in are suitable. That's the word. They have to be suitable to you. And that's not to be taken lightly, but it's not the same thing as a fiduciary. Now, 2 things about that. When you go to a commissioned broker, which is what Dave Ramsey recommends, as I understand it, they're going to put you in mutual funds that typically have sales charges. These are they call them loads, front loads, there's back loads, but typically the way most of them work is for every dollar you invest, they're going to pull $5.75 every dollar. Every $100 you invest, they're going to take $5.75 of that $100, 5.75%, and say, thank you very much. That's now ours. And we'll invest the rest. And that's how it works. And that 5.75% goes in part to pay the salesperson, your broker, your commissioned helper, their fees. They also get paid a portion of the expense ratio that comes out of the fund every year as well. And that's how it works. Now, I point that out because the funds we're going to be looking at today for the Dave Ramsey portfolio are what are called American funds. Those are the funds that based on what I have read and listened to Dave, I believe that's what he uses. Now, why do I say I believe? Because I don't know anywhere where he's come out and said, American funds are what you should use. Or I don't even know that he's explicitly said that. He's talked about funds with certain start dates and performance, and folks have used that to conclude he's talking about American funds. But this is a really important point. I don't believe Dave has ever, and in the chat, correct me if I'm wrong, I don't think he's ever actually recommended or even discussed specific mutual funds. And I want to make that point clear. So when we put together the Dave Ramsey portfolio, we're doing our best to pick funds based on the information we do have from Dave. Hope that makes sense. All right. So with that, here are the American funds, and I've got a link to this page below the video, and they've got, there we go, got our growth funds, right? We've got our growth and income. Now they don't have anything called aggressive growth, but we're going to use small cap for that. And we'll take a look at them as we go. So one thing I'll point out, and this is just looking at one of these funds. And if we go to the quote page, we'll see the expense ratio. It's right here. This particular fund is 61 basis points. Morningstar used to put the load fees, the sales charges on this front page. Now, for some reason, they've buried it into this price tab. So you got to go to the price tab. Here it is. And you see the load. That's what that is. That's saying that's a sales charge. So when you invest $100, 5.75% or $5.75 is going to come out immediately. All right. It's just a one-time fee. Now I want to say, and I may have alluded to this, but just to be clear, I'm going to come back to this whole fiduciary versus commission broker issue when we're done looking at the portfolios. I want to jump into the portfolios now. I'm going to come back to it because you may think that the fiduciary is the obvious choice. And I'm telling you right now, it ain't the obvious choice. There are circumstances where I would absolutely pick a commission broker selling American funds over a fiduciary who in theory has to take my best interests and put them before their own. So I'll come back to that as we sort of enter the Q&A section of today's video. So let's get right to the portfolio. And actually, let me make sure I've got this working. Okay. So we're in Portfolio Visualizer. We've looked at this many times, and I've already set up the portfolio that was sent in by Patrick, and it's this right here. So we're looking at these funds. This is American Funds, AMCPX, which is sort of a U.S. company growth fund. We've got ANCFX, which is a American Funds Fundamental, and we can actually just quickly look at that one. I don't think this is the one. Oh, here it is, ANCFX. Okay. We can go to the portfolio just to get a quick look at it. And we can see that it's mostly US, but there's 18% non-US. It's a large cap blend fund. And by the way, if you go to this page in American Funds, which is capitalgroup.com, by the way, you can click on any of these funds and get more details. And we've got an international fund, and we've got a small cap world fund. So those are the four funds. These were the percentages that Patrick sent me. So you'll notice they're not 25% each. So we'll change that when we look at the second Dave Ramsey portfolio. But I think this is a reasonable representation of Dave Ramsey's investment philosophy as I understand it. Now, if we analyze this portfolio, the first thing we always need to look at, what's the time period? All right, so this is the data that Portfolio Visualizer has. So it's a good long, that's 30 years. That's good, right? And we can look at it. It's done, I think, incredibly well. 11.17% is the compound annual growth rate. Standard deviation is consistent, I think, with a 100% stock portfolio. And so it's done extremely well. Now, two things to keep in mind. This does account for the expense ratios of these funds, and these funds have the expense ratios. Well, you can look at them all here. The expense ratios on the far right. The funds we're looking at are in the 60 to 80 basis points for the most part. The small cap fund is right here. It's 108 basis points. So, but whatever the expense ratios are, they're already factored into these returns. However, the sales charges are not. And there's no way, at least easily, to model the sales charges in Portfolio Visualizer. What you would have to do, as far as I know, is open up a new tab, and we'll change this. Actually, we'll change this to none. And in this case, remember, we started with $10,000. Actually, we can look at it here. We started with $10,000, and there were no contributions, just a lump sum. So we could do the same thing, but just reduce the amount, right? By the amount of the sales charge. And then here we can put in, well, it's going to make me refresh. Hang on for a second. I'll just copy this, refresh. Yes. Okay. Get rid of the contributions. Come back here. It should be in here. Yeah, there it is. There we go. And analyze the portfolio. And we can ignore the compound annual growth rate for just a moment. And why am I getting it? Oh, hang on. I know what I did wrong. I need to get rid of this. It was limiting the available data. Well, that's interesting. What is 2007? It's the exact same fund. Huh. What am I doing wrong? We're going to start all over. We're going to clear this. We're going to clear all of these. I wonder if I have different tickers in there because the time period is different. And we're going to go back. Let's try it this way. Huh. Am I picking the right one? Portfolio. Maybe I picked the wrong one. Let's make sure I got portfolio one. I do. I don't know why the time period is different. Well, in any event, we can come back and make this 2007 to compare the two. I don't know why the time period is different. We see 35,000 versus 33. That gives you a rough idea of the difference because of the fees. So it's important to, the real takeaway, and I'm sorry that I had that time difference. I'll have to look into why that's doing that. I'm sure it's user error, by the way. I think that's a given. But in any event, I just wanted to point out the sales charges aren't accounted for in pretty much any portfolio analyzer. That would be true with Morningstar, Portfolio Visualizer, Stock Rover, Personal Capital. They're not going to include that. Now, having done all of that, I'm going to set this back to 1985. Let's see, it'll probably stick with 2007. No, it goes to 1991. All right. And what I'm going to do is say, okay, well, that's great. What if we just said, okay, we're just going to put it in an S&P 500 and compare how that did. It's all stocks, so that's good. And let's just keep it simple. So the first thing we have to note is the time period changes because it's still a long time period, but the SPY, which is a S&P 500 ETF, shortens the time period a bit. But there are two investments. Again, this one up here is going to have a load fee that's not reflected, but the expense ratios are. And look at that, they're pretty much spot on. They've done equally well. I mean, they're, again, we know that the load fee is going to reduce portfolio one, but the reality is American funds, by and large, have been solid investments. And certainly the four that Patrick sent in have done really well. Now, we could say, well, let's change it a bit because this has small cap and international. So what can we do? Well, for international, we could just put in VX US, which is a Vanguard International. And for small cap, one thing to note on Portfolio Visualizers, you can search. So you can type in Fidelity or Vanguard or whatever, and we'll just put in small cap index. There it is. So we have to change this. Let's put 30% in international. We'll put 10% in small cap and 60 in, keep that in the S&P 500 and then analyze it. And big difference. right? Now, part of the problem is we've got even a shorter period, still 20 years, right? But in this case, it's been, it's a pretty significant difference. I suppose one thing we could do is try to keep it a little more consistent. We'll put 15% in small cap to mirror the 15 here. We'll put 25 in international to mirror the 25 here. And then we've still got 60 there. And if we do that analysis, still the Dave Ramsey portfolio has come out ahead. Now, I think the real takeaway here is not that one portfolio is better than another. We could spend all day comparing the Dave Ramsey portfolio that Patrick sent in to every lazy portfolio, the Warren Buffett portfolio. We could go on and on and on, and some are probably going to beat it, some are not. We just looked at one that tied it before the sales load charge, right? So really outperformed it, and one that fell below the Dave Ramsey portfolio. But I think maybe the more meaningful takeaway is that the Dave Ramsey portfolio, as Patrick sent in, has done reasonably well, right? And that's not surprising to me because I spent some time studying American funds. Now, what I want to do next is reset all of this. And so I'm just going to go back to the homepage of Portfolio Visualizer. And we're going to look at the Dave Ramsey portfolio that I created. It's right here. So I've done a couple of things to change it. The first is, you can see I've got 25% in each fund. I think that's more consistent with what Dave has talked about. The three funds are similar. The one big difference is I added American Funds Growth Fund of America. Why have I added that? It's because that fund, I believe Dave has alluded to, again, not by name, but based on comments he's made. I could be wrong, but that's what I believe. And it's sort of one of their flagship funds. If you go over here, we can see it's right here. Look at this. Since 1973, it's returned 13.94%. And you'll notice here, these are average returns with sales charges. So this fund has been phenomenal. Now, whether it'll be phenomenal in the future, I don't know. All I can tell you is the history. So I've included that, but we've still got here the small cap, here the international, and this was the one of the growth funds that we looked at. Growth in it. It's actually, I kind of use it as sort of growth in income. So if we look at this portfolio, it goes again back to 1991, and it's done extremely well. In fact, we could compare it to the Dave Ramsey portfolio that Patrick sent in and compare those two. And so they're pretty close. I don't know how well you can read those numbers, but the final numbers for I'll call it my Dave Ramsey portfolio was 273,000. Patrick's Dave Ramsey portfolio was 259. I think the more interesting thing is what happens when we start to compare this to like an S&P 500, for example. We'll do that first and see what we get. And you can see it's actually, and I'm trying to make this a little bigger. I don't know how big I can get it. It's actually the Dave Ramsey portfolio as I created it. And I think it's a fair representation of Dave's investing philosophy. Has actually outperformed the S&P 500. Now, not by a huge amount. We're talking about 15 basis points, and we don't have the sales charges in there. So when you factor in sales charges, it's going to slightly underperform the S&P 500. So you've got to factor that in now. But with that, they're pretty similar. Now, the standard deviation of the Dave Ramsey portfolio, as I envision it, slightly higher. Its volatility, as measured by the standard deviation, is 15.5 versus 14.7. As a result, its worst year is a little worse, by 5.5%. And its max drawdown is 2% worse. This is probably the Great Recession. Yeah. But to answer Patrick's question, I would say that the Dave Ramsey portfolio, as I understand it over the last 30 years, even factoring in the sales charge, has roughly performed similar to low-cost index funds, whether it's sort of a Warren Buffett approach where you just use an S&P 500, or maybe we talk about a three-fund portfolio. That's a little difficult in the context of Dave Ramsey because he doesn't invest in bonds, so we have to make that change. But by and large, I think they have done about as well. And that's in part because American funds, which has been around for a very long time, I want to say since the 1930s, but I may have that wrong. They have some pretty solid funds that even after the fees have done extremely well. Now, that kind of there's the portfolio. There's the comparison. I don't think that Dave's portfolio, again, as I envision it, necessarily outperforms a low-cost index fund portfolio, but I think it keeps pace, does pretty well. Now, again, we could compare it to another 50 different, lazy portfolios, and I'm sure some would beat it. But I think by and large, it's been close. And when you add in sales charges, you may say, well, it'll underperform a little bit as compared to, say, an S&P 500. But the flip side is you are getting someone to help you with your investments, right? And I know a lot of people want that. And that sort of brings me now. So that's for those that just wanted to see my comparison. And yes, we could compare them 1,000 different ways, but that was my comparison. There you go. I do want to talk about this fiduciary versus, I'll call it a salesperson issue. I've heard people actually say it's immoral for Dave Ramsey to recommend basically a stockbroker, a commissioned salesperson, over a fiduciary. And it's certainly true that I would not use a commissioned advisor. If I were going to get help, I would want a fiduciary. But here's the thing that I think people miss. If you hire your typical investment advisor, they're going to charge you roughly 1% of assets under management. That's most of them. That's not all of them. It's most of them. Some will charge you more. I've seen as high as, I know for sure, one very well-known person, 1.75%. Those numbers tend to go down the more you have to invest, but the point is they're expensive. And most, in my experience, put your money, they won't put it in an American fund because they're not going to charge you and then make more money from the mutual fund company. They couldn't do that. But they are typically going to put you in actively managed funds that cost 60, 80 basis points, 100 basis points or more. And so they legally have to put your interest first in selecting the investments, but that doesn't mean that they can't cost you a fortune, and they do. And so if I had to choose between a fiduciary who's going to legally have to keep my interests ahead of their own, who's going to do that, I would take a Dave Ramsey commissioned salesperson and American funds over any day of the week. It's not even a close call. Keep in mind that the 5.75%, and you're going to pay it each time you make a contribution, whether it's a lump sum, dollar cost average, whatever, it's a one-time fee. Assets under management, you're just lucky because you get to pay that every single year until you die. And so when you do the math, assets under management fees, AUM fees that are like 1% or higher plus high-cost mutual funds are far worse than a front-loaded sales charge. Now, the good news is those aren't our only two choices. Even if you don't want to be a do-it-yourself investor, there are plenty of fiduciaries that charge a heck of a lot less than 1% and use low-cost index funds. Well, Vanguard is one, right? I think there's 30 basis points, $50,000 minimum. But they have a sort of a robo-advisor version where the limits, the minimum is much lower, and I think the cost is lower. There are robo-advisors like Wealthfront, Betterment, and SoFi. Betterment has, I think it's for 40 basis points, you can get a human advisor. There are folks, Asset Builders, another one I've mentioned. I don't have any relationship with them. I don't have any relationship with the other ones that I've talked about either, but I know them better. What I know about Asset Builder is that they use low-cost index funds, and their fee is relatively low. I don't know what it is off the top of my head. I think they're a firm out of Texas. And then there are folks that just charge a flat fee or an hourly fee. I know Rick Ferry does portfolio analysis for a flat fee. I've mentioned Mark Zorrell of Plan Vision. It's a very small fee, and he'll set you up with what he thinks is a good asset allocation and specific funds, and you can do the trade yourself if that works for you. So there are a lot of ways to get low cost help. But if I had to go with a 1% AUM plus high cost mutual funds versus a Dave Ramsey advisor who's going to put me in American funds, I'd take the Dave Ramsey advisor for sure. Again, when you hear people make that comparison, you just have to keep in mind, but those aren't your only two options. All right, well, there you go. That's everything I got. So I will turn to the chat, and I see my name lighting up in orange. So that's good. And by the way, Patrick, thanks for the email. It's a great email. And yeah, if you look at, let me just show you one more thing. I get kind of excited about this. I did this portfolio here. I compared my Dave Ramsey portfolio with 100% S&P 500. What if we instead use American growth funds, that flagship fund that I mentioned has done really well? Let's put a third portfolio that just has this one. Look how well it's done. 159 versus for my Dave Ramsey portfolio versus 153 for S&P 500 versus 238,000 for the American funds, the growth fund. Yeah, 12.11% compound annual growth rate. Yeah, it's been amazing fun. If you're thinking about actively managed funds or even American funds through an advisor, commission salesperson or whatever, the one thing to keep in mind is how are you going to handle if and when one of these actively managed funds starts to underperform the index for a couple of years? That's the tricky thing. Because it's easy to look back, oh, over 30 years, look at this, it's been great. But what about those years where it wasn't so great? It's kind of like Bitcoin in a way. Oddly enough, there's a I think a fair comparison. If I had invested in Bitcoin in 2009, I'd have this much money. But there may be some people that bought a lot of Bitcoin or mined a lot of Bitcoin in 2009 and still haven't sold it. But that's not what most people do. They sell, then they buy, and they sell. They regret selling, they buy. I'm not a Bitcoin fan, but the point is, it's easy to look at long-term data and say, boy, that would have been great. I invest in just the S&P 500 or just the American funds or whatever, just the QQQ, or but you got to live it. And so, like American funds, that third portfolio, they were all down a lot. But this portfolio was down 48%. When an index is down, you're like, well, it's not the manager, it's just the index. And maybe if you owned this fund, you'd say, well, I'm down, sure, but everyone else is down, and so I'll just live with it. But you got to be able to make sure with an active approach to investing that you can live through these downturns. People look at Berkshire Hathaway and say, if you'd invested in whatever, you'd have so much, but people forget that the value of a share of Berkshire has been cut in half a couple of times. You have to live through that. Okay, Clarissa, first question. Hi, Rob. Is a high turnover rate mutual fund bad? I've seen some with 45%. What about 12B fees as well? Do all funds have them, and will it cost me when it's time to withdraw? So there's two issues. Let me talk about the turnover rate. There's two issues with high turnover. The first is cost, the transaction cost. So there's buying and selling. And those costs are not factored into the expense ratio. And you think about it, it makes sense because they're not going to know ahead of time until they actually buy and sell during the year what their transaction costs will be. That's the first thing. And then for high turnover, if it's in a taxable account, it can end up generating taxable income. And in theory, it can generate taxable income for you even if you don't sell any shares. And actually, this question came in from a viewer this week, and I promised to talk about it briefly. Normally, you think about capital gains. We know that if a fund pays dividends, we'll pay, and it's in a taxable account, we'll pay, it'll be taxable income in the year the dividends are distributed. With capital gains, we normally think about it as, well, as long as they don't sell, I'm good. I'll only pay them when I sell. But with some actively managed funds, you can actually get some capital gains distributed to you, even if you didn't sell. And that typically happens in December, as far as I know. It's been my experience. And so you can actually have people that invest in November and then get whacked with capital gains, the next month. So you have to be very careful with that. With index funds, even index mutual funds, in my experience, that doesn't happen. Some would say, well, if you have an ETF, you can really avoid it. The theory is, and it's not theory, but it's true. If a lot of people want to sell their shares of a mutual fund, they sell them back to the mutual fund company, Vanguard, Fidelity, whatever. And if more people want to sell than new investment coming in, the fund may have to sell some of its underlying investments to redeem those shares. And that could end up triggering capital gains, even for those people that don't sell, aren't selling their shares. In my experience, that doesn't happen with index mutual funds. I'm sure there are exceptions, but I can tell you with Vanguard and Fidelity, I haven't had that issue. But if you're concerned with it, you just need to evaluate the fund and see what the distributions have been. So that's the issue. So in terms of the 12B, it's 12B1. What did she say? Yeah, 12B1 fee. It's an operational expense. I can show you. I pulled it up just so I make sure I got it right. And it's part of the fund's expense ratio is the point I really want to make, at least according to Investopedia. But no, I think that's correct. So obviously very important. But I think that if you know the expense ratio, you should be okay. Frank, could you help me understand TIPS yields? I doubt it, but we'll see. In particular, VTAPX has a negative real yield, but doesn't BND also have a negative real yield too? It's kind of hard. Real yield. That's hard to say. When I was like in elementary school, I had a gap between my two front teeth. I could put a nickel between my two front teeth, and I talked with the lisp like this, and I had to go to speech therapy. I don't know why I just told you that. Okay, let's look at VTAPX. We'll go to Morningstar. I assume it's a TIPS fund, but I don't know the ticker off the top of my head. Okay, it's a short-term TIPS. So first of all, when we talk about real yield, there's nominal and there's real, right? Nominal is sort of the yield. Real is after inflation, right? That's what they mean by real. So let's get real after inflation. So according to this, and I find this really hard to believe, but according to this TTM right here, see that? I don't know how big I can make it. It's a little bigger. That's trailing 12 month. That's what TTM means. So in other words, the last year, 3.43%. That really surprises me, because this is a short-term TIPS fund. Now, inflation has obviously gone up, so that may explain it. It must. So I guess one question I have for you, Frank, is where are you getting that the real yield is negative? I mean, right now, yields on TIPS, this is a fund, but the stated yields on TIPS are negative, because remember, TIPS are adjusted for inflation, right? The principal. So the way I explain it is almost like it's like buying a U.S. government treasury bond, but getting an insurance rider that says, "Hey, if inflation goes up, we got you covered." But that insurance rider is not free. You have to pay a premium, but they don't actually send you a bill. They start you out with a lower yield, right? So let's see. If we go, let me just see if I can show you an example of this. Yeah, this is just from our friend Google, but it's pulling in Wall Street Journal data. So I'm assuming this is accurate. This is I don't know what the duration of this is, but you can see it's got a negative yield of 50, we'll call it 57 basis points. And that's not uncommon. The longer the term, that's going to go up typically, but it's going to go up now. In any event, let's go over to bonds or BND for a second. I don't know what its 12-month trailing yield has been. I'm going to guess it's going to be lower. I think. Yeah, 195, which is interesting because this is an intermediate term bond fund. Let me make it a little smaller here, meaning the maturity of the bonds it owns and their overall duration. Well, the duration is going to be around 5 or 6 years, I'm guessing. We've looked at this before. We just go to portfolio tab. Yeah, okay, duration's almost 7. Again, that means if interest rates go up by 1%, the value of this fund will go in the opposite direction by a percentage roughly equal to its duration. So I've not been following the TIPS market, but I've got to believe that short-term TIPS fund has done well because inflation's gone up, right? So it's interesting. Yeah, I guess the real yield, given what inflation is right now, is negative for both of these funds. But obviously, the TIPS fund has done better, at least based on income yield over the last 12 months. So I don't know. Frank, I hope that helps. Brian wants to know, why doesn't Dave Ramsey just tell everyone which fund he picks every year? So I've watched Dave on this. I don't watch the show a whole lot, but there's one video where I think he's got it looks like he's got his statements, investment statements, or some kind of information in front of him. And he's reading, he's got one fund that was started at 73, I think is the year he mentions, which is why we think it's the American funds, the growth fund I showed you. And another one that was started in the 30s, and these are the returns. Of course, I don't know why he doesn't, but I think it's probably because he doesn't want to be viewed as recommending a specific investment. And given his popularity and the size of his audience, I can understand that. And also, I guess if you wanted to be cynical, you could say, well, he wants people to hire one of the advisors, investment professionals in his network. And if he just gave the information out to everyone, they wouldn't need to hire them. I don't know if that's true or not. I suspect it's more about just not wanting to be viewed as recommending a specific fund. That's my best guess. I mean, look, Dave Ramsey's got to be worth a fortune. So I don't think the money, well, I don't know. Some people can never have enough, but I don't get the sense that's, I don't know. I get the sense it's just he doesn't want to be viewed as recommending a specific fund. Anyway, Brian, that's my best guess. All right, next question from Frank. Please speak to the possibility of stagflation and how a retiree should plan for it as an index fund investor. That's a great question. So stagflation, I lived through it. It's normally when you have inflation, prices are going up, right? That's what inflation is. You can often have some level of growth that's powering these prices. It's usually like growth is like we need to slow things down, right? But there are times when you can have high inflation and the economy's stagnating at the same time. And that's what we had, 70s? I guess, I don't know when it officially ended. I know that interest rates started to come down, in 82, I think. And so I think we've got a lot of difficult issues ahead of us. I don't know that they'll necessarily lead to stagflation. We'll see. But I think we're at a number of extremes. One extreme, interest rates obviously are at an extreme on the low side. We have stock valuations, which are at an extreme on the high side. Not the highest extreme. I think that's 99, right? But I mean, second highest. So definitely an extreme. We have obviously our government's debt is at the highest. Of course, it's always at the highest. Right? I mean, until we run a surplus in a given year, it's always going to be higher than the year before. But it's obviously grown significantly for a number of reasons. One of which being the stimulus that we pumped into the economy because of COVID. So you've got debt is at an extreme. The deficit is at an extreme. The amount of money pumped into the economy is at an extreme. I heard 11 trillion printed since COVID. I don't know, maybe in the chat, let me know if I'm right about that. That's just hard to even fathom. We have a Fed that has a massive balance sheet that is going to be, I think, really hard to unwind. And if you think about it, how would they unwind it? So they've got rates as low as they can get them. They've been buying bonds. So think about what happens when they do that. The Treasury prints a lot of money. They give it to the Fed. The Fed goes over to Chase and says, I'm going to buy some of your bonds. Thank you. Here's a bunch of cash. By the way, you know what Chase does with it? It says, thank you. I'm going to invest it back with you at the Fed. Anyway, it would be illegal, I think, anywhere else. I don't know. It's just crazy. In any event, so what are they going to do? Well, the first thing they'll do, right, is stop buying. And then they'll start selling. But of course, when they do that, they're going to start sucking cash out of the economy, right? Here's bond, I'll take the cash back. And then eventually, I've heard not till 2023, who knows when. Eventually, in theory, they'll start raising rates. So all of those things, in my view, put us in a time of I guess we're going to have a black swan event. That's my view. I don't know what it's going to be, and I don't know when. And so back to Frank's question, I don't know if it'll result in stagflation. By the way, the other thing that I think will happen is I think there is going to be an event involving crypto that affects significantly the financial system as we know it. There's about 2.5 trillion, I think, in crypto. Where in the heck did that money come from? It didn't come from stocks. They're at an all-time high. It didn't come from housing. It's at all-time high. It didn't come from bonds. They're at an all-time high, which is why their yields are so low. I guess it came from the government pumping money into the economy. I don't know where it's coming from. Savings are at an all-time high. Banks have so much in deposits they don't want anymore. Corporate balance sheets, they've got cash that they don't know what to do with. So I do think, and you have crypto, and some of you are crypto bulls. I get it. I'm not here to debate that, but I will say that I think the thing that strikes me about Bitcoin in particular, since it's the number one crypto, is it's utterly useless right now. I know in theory it can be a currency, but it's not. It's a practical matter. Some people say it's digital gold. Okay, it's a store of value. I guess time will tell. Maybe it is, but it's literally something we created out of thin air at huge cost. It sits on a thumb drive. Well, for some it does, or your Coinbase or PayPal or Robinhood account. It's zeros and ones. It can't be used for anything as a practical matter. I mean, I know in theory you can buy some things with it, but that's not why people are buying it. And we're talking $1 trillion. Market cap's probably higher than that now. I think something bad is going to happen. I don't think that can lead to good things. That's my view. So, Frank, what do we do about that? Well, I think the things that I do is, first of all, I recognize that while I can make all these predictions, the truth is I have no idea what's going to happen or when. So it's pretty basic stuff. I get as much diversity as I can. By the way, that doesn't necessarily mean a lot of ETFs and mutual funds. You can have great diversity in just a couple of funds. You could just, if it makes sense, a target date retirement fund, phenomenally, it's tens of thousands of bonds, thousands of companies across the globe. It's incredibly diverse, but you want diversity in your investments as much as possible. You want, to me though, it goes beyond investments. I think you want to stay as much out of debt as you can. I think you want to, if you can, have other sources of income. Even if you're retired, I kind of view myself as retired, but I make money from this YouTube channel. It's not, I'm not giving Elon Musk a run for his money or anything, but it makes a few $1,000 a month. I have a book that makes a little bit of money. I have some websites that make a little bit of money. I still am started up again, the Dough Roller Money podcast, which I do as sort of a consultant. I don't own it anymore. I still do a little work for Forbes. And so I guess someone say you're not really retired. I get it, but it's very lifestyle friendly. And to me, Frank, those are the kinds of things that in some ways are more important than the perfect asset allocation. I mean, you want a good one, a lot of diversity, but that can only get you so far. And if you want to diversify into crypto to some extent, fine. If you want gold or commodities, fine. It's not what I do. Commodities would probably be the first thing I'd add. And I've thought about it, and maybe I will, but it's not what I do. That's all fine, but it's only going to get you so far. And so, to me, keeping your debt none if you can help, if you can get there, but as low as possible, and diversifying your income sources. Yeah. All right. Dave asks, in a Roth IRA, I have equal parts of VTI, which is the Vanguard Total Stock Market Fund, SCHD, which is Schwab's, we've talked about it, their dividend fund, and RSP, which I wouldn't know this, but Dave tells me is an equally weighted S&P. What are your thoughts on RSP and this mix of ETFs? Bonds, international, and other accounts. Go Buckeyes, go Reds. Well, Dave, I think whatever you say is brilliant. I grew up in Ohio in the 70s. So, Pete Rose, Joe Morgan, Concepcion, Tom Seaver when he came from the Mets, I think, right? Of course, Johnny Bench. I can't name a single player on the Reds team right now, not one. But I still love them. Anyway, so RSP, equally weighted S&P. Let's take a look at that in Morningstar real quick. Here it is. Oops, I want to go to portfolio. So a couple of things to note. So a typical S&P 500 index fund is cap weighted. And in fact, let me just go to Morningstar here and we'll compare the two. We'll look at SPY. So what that means is the bigger the company, the more of that the portion of the fund will go to that company. So when we look at SPY, what that means is the big companies like Apple and Microsoft and whatnot will take up more of the total portfolio. So in other words, every $100 you invest, for example, we can even look at it. Every $100 you invest in SPY, $6, we can see it right here, goes to Apple. $6 almost go to Microsoft and so on. Over here, we go down to the holdings. Everything gets 29 cents, right? Or I guess there's some that are a little lower. And so what that means is that the sort of net effect of that, when we look at the fund as a whole, is that the overall weighting of this fund, it's going to be have a smaller company size. So if we go ahead and market cap, we can see it here, right? Here's the S&P 500. It's going to be way up at the top, right? This fund you can think of it as giving you more exposure to smaller companies. And if we look at the market cap, the average market cap of this fund, this equally weighted fund, is 37 billion. And for a typical S&P 500, it's 200 billion. The other difference is this is weighted more towards value because the big companies tend to be growth companies. So that's the difference. I think I would view the S&P 500 as sort of investing in the market, or VTI as well. They're very similar. An equally weighted S&P 500 is a very different investment. And in fact, we could, why not? Let's back test these real quick. I have no idea how this is going to play out. So we'll put in SPY, 100%. Well, you got to know that the S&P is going to do better, at least recently, right? It's got to. But I don't know how much data we'll get here. I don't know how long RSP's been around. Okay, since 2004. Oh, look at that. It's actually outperformed. That really surprises me. It must be because if we look at the return data, that's interesting. Boy, this year right here was a big year for the equal weighted. That was 09. So yeah, the Great Recession really clobbered the S&P versus equal weighted. So like if we came back up here and we changed the date from 85, let's just start in 09, just to show you the difference. I'm going to guess the S&P now would outperform. I could be wrong. I'm wrong. Look at that. It's still outperformed. Let's go one more year. Real quick. So yeah, we had to get out of 09. So there it outperformed. So over the last decade, S&P's outperformed. But when you go through the Great Recession, equal weighted did better. So there you go. Those are the differences. I mean, it's a 100% U.S. approach. And you mentioned you've got international and bonds in other accounts. I mean, in some ways, the RSP is like your way of getting some more small and mid cap. But you do have that with VTI. So, one thing I would suggest, I'm not going to do it, but use Portfolio Visualizer. Compare those three funds with just VTI and SCHD, where you take whatever percent you have in RSP and add it to the VTI for the portfolio that just uses the two funds. I'd be curious, and actually, I will do that. I'll do something similar to that right now. Let's put VTI in here. We'll go 100, and we're going to go back. We'll set this back. It won't go to 85, but we'll set it back to 85. Yeah, that's interesting. See, so this is this is kind of my thought process. So VTI actually outperforms the equal weight. My thought process was, while the equal weighted portfolio gives you more small and mid cap exposure, well, so does VTI. And so I wonder if you really need this equal weighted fund, or you could just take the percent you have in here and put it in VTI. That being said, they're still pretty much neck and neck. The equal weighted has got more volatility, so that's something to think about. But there you go. Scott says, Ramsey's portfolio offers no hedge. As a retiree, this portfolio has too much risk in a down market. Big proponent of three-fund portfolio, investment grade balance, and equal equity value. Yeah, I mean, that's the problem, Scott. He doesn't have any bonds or fixed income. And I think you can make that argument when you're not in retirement. But once you get into retirement, there are exceptions. That's why you got to factor in your own circumstances. If you can live on, say, 2% of your portfolio in year one and adjusted for inflation, and you're very comfortable and happy, and you plan to leave a lot to your children or charities, 100% portfolio may be perfectly reasonable. But when you look at Bengen's analysis, he's the father of the 4% rule. 100% portfolio didn't do well. You needed somewhere between 25 and 50% in bonds. He thought you should get as close to 75% in equities as you felt comfortable. In later research, he used 65% in equities. But the point is, if you live through a Great Depression again, and your stocks are down 90% in 4 years, it's going to hurt. Now, and that's particularly true if you need 4 or 5% in year one. Again, if you can live on a lot less than that, or maybe you could say, I've got Social Security, I've got some pension, and I want to spend more than that. So I plan to use my investments. But look, if stagflation, as Frank asked about, hits us, and I need to buckle down and really spend less for a couple of years, I can do that and just live off my fixed income. Again, every situation is different. You need to think about the what ifs. And so, but by and large, yeah, I'm a little nervous about the idea of having 100% stocks in retirement. Look at that. There are no more. That's it. There's no more questions for me. I'll give you a couple of minutes, I'm happy to answer more. In the meantime, I'll just pull up a chess problem for Salty. By the way, if this is your first time watching, you're like, Rob, you're going to do what? So I'm a geeky chess player. And we'll do chess puzzles every now and again on the live stream. So there you go. It's black to move. Look at this. By the way, my rating for puzzles is 2881. I don't want it going down, Salty, so I'm expecting a good answer. While Salty and everyone else who wants to works on that problem, I'm happy to answer any more questions that you have. And putting the @RobBurger is great because it lets me go right to them. So, by the way, while you're looking at that, investments today, certain kinds of investments seem to get all the publicity, right? Bitcoin, Tesla, QQQ. And that's generally just not the way I invest. If I'm going to invest in individual stocks, I try to approach it as a value investor. And I sometimes don't do a lot of analysis. When I invested in Apple for the first time in 2013, I actually sort of did a cash flow. I said, okay, and let me walk through what I did. I said, here are their profits. And I adjusted their profits. I said, okay, I'm going to account for any depreciation that they took and any new capital expenditures, right? I'm going to offset their profits with those two numbers. Because remember, you can spend a ton as a company on capital assets and you'll depreciate those assets over some number of years, so they won't affect your profit in the year you buy. If Ford had to buy all new car manufacturing equipment, they spent $1 billion. They wouldn't reduce their profit that year by $1 billion. They would spread it out over however many years. And so I kind of wanted to make those adjustments. And you say, well, Rob, that's pretty interesting. You're brilliant. Okay, you probably didn't say that, but in case you did, I'm not. That's what Warren Buffett does, and he calls it owner's earnings. And if you think about it, here's an easy way to understand owner earnings. Let's imagine your own budget, and you're saving $1,000 a month after all your spending, and you feel really good, excited, put in a savings account. At the end of the year, you got $12,000, and then you need to replace your furnace. And you think, well, I thought I was saving $1,000, but now I got to spend whatever, $5,000 on a new furnace. And you realize, there are some expenses like that: a new roof, a new car. They don't come up every year. If you were a company, you would call those capital expenditures. And so you have to account for those. You can't, as a company, simply pull out all your profits. You've got to recognize that, yeah, you bought some machinery, some equipment 7 years ago, but in 4 years, you're going to have to replace it. And so owners' earnings are kind of like what the owners could take out of the company after they leave enough in there to deal with all of these capital expenditures. And so any new capital expenditures, or the stuff the company bought this year, depreciation is stuff they bought in the past and they've expensed a portion of it that year. So anyway, I took that number and then I made some assumptions about Apple going forward. And I tend to be very, very conservative. But what I concluded was, even if they had virtually no growth, at the time their stock had fallen from the 700s, this is a couple of splits ago, from the 700s all the way down into the 90s. And I said, even if they have no growth at all, their stock is well undervalued. So I bought a bunch of it. And I did the same thing in 08, 18, and 19. Sometimes I'll just look at it very briefly. Like I looked at Wells Fargo and Bank of America last year and the first part of this year, and I said, look, I don't need to do a cash flow analysis. I'm reasonably confident that they're undervalued just based on their book value. They were trading below book value. Bank of America is not now. Well, Wells Fargo, I don't think is either. Citibank is. And I said, look, Wells Fargo's got issues. We all know that. But I'm going to take the chessboard off the screen for just a minute. But my theory was, look, as long as they don't go belly up, and they're not going to go belly up. I mean, the balance sheets of banks today are phenomenal, certainly compared to 08. I should do pretty well. Well, that was kind of my analysis. I don't know that it'll go up this year. It may go down. And in fact, Wells has had some issues. They're not out of the woods yet in terms of the regulatory issues. Bank of America is like firing on all cylinders. Interest rates are still low, so their net interest income is still not great. I think Bank of America has improved the last quarter. But that was my analysis. I've invested in Bank of America and I invested in Wells Fargo. And these are not sexy companies. These are not Reddit, Wall Street bets. No one's talking about it. These are just like, what? It's like, yeah, Rob, that fits. You're an old guy with gray hair. Yeah, that would make sense. That's what you invest in. And the returns have been phenomenal. Now, I'll say, and I'll say it again, they could crap out tomorrow. Who knows what tomorrow's going to hold? But my thesis was they're undervalued. And if I'm willing to hold on for 10 years at a minimum, I should do okay. And I still believe that. Now, my Wells Fargo stock is up like 60%. I don't even know. It's ridiculous. Let's look at it. I'll pull it up. And then I'll look at the chess answer that you guys gave me. So this is, let's see, here's my Wells Fargo. This is just Apple stock. And so if we look at 1 year, so I bought it right in here. It was I don't know what I paid, around 30. It's at 50. So that's not bad. Boring old bank. And Bank of America, I did better because I bought that in October. So let's say, I don't know, it was around 23. So it's doubled. I've doubled my money in a year. And that doesn't include dividends, right? This is just price appreciation. So, I don't pretend to be some great stock picker. I don't have some newsletter to sell you. I should. I have a free newsletter. You can subscribe to that below the video, but I don't give you stock picks because I don't have any. I marvel at like Jim Cramer. I don't know how he does that. Just he's got like a gazillion stock picks every day. Anyway, so yeah, that's kind of how I think about my stock portfolio. There's only 4 companies: Apple, Berkshire, and the 2 banks. That's it. Okay, I see more questions. I'll put the chess problem back on the board on the screen here while I look at the questions. Let's see. There we go. Looks like a tough one. I don't know. Anyway, back to the questions. Oh, you guys are putting the answers. Here we go. All right, back to the questions. Enough chess for the moment, but I see you've got some answers. Oh, this is interesting. Let me go. So Vinyl says, Rob, the money in crypto doesn't really exist. There's not the liquidity for all the crypto holders. Well, but someone's bought it at some point. It may not exist so that they could liquidate the entire thing, but that's probably true of a lot of investments. Tony, when answering Frank's question, what to do, referring to stagflation, you forgot the most important thing, good health. Absolutely true. You're absolutely right. I forgot that. And I work out. In fact, I'm going to work out later today. I've even got, sometimes I have kettlebells. I got a dumbbell back there. I was doing planks. You hold a plank, but then you take a dumbbell and you move it over, right? And I think I was doing a high plank. Grab some weight. It could be a sandbag, kettlebell, dumbbell, move it over, right? Good core exercise. Absolutely right, Tony. All right, some more questions. Slim, at age 44, I have 11% in bonds. Too little, too much? Is cash better right now instead of bonds? Well, depends what kind of bonds they are. I mean, you've got short-term treasuries, you've got long-term high yield, long-term emerging markets. But I don't think 11%. I think 11%, an 89% stock, 11% bond portfolio, in my view, for someone middle-aged with a traditional retirement, that's basically what I had, more or less. I think that's reasonable. Is cash better? I tend to err on the side of shorter-term income investments right now. I don't know that I'm not convinced that's the smart thing to do. In some ways, I think I'm just market timing. Normally, I'm intermediate term. At one point, it was 50% treasuries, 50% tips. And the negative yield spooked me, and I moved some of it to basically money market accounts. And I'm not sure that was the right thing to do. I haven't been hurt from it. It's not like, I don't think my performance, first of all, I'm about 80-20, so only 20% in bonds to begin with. I don't think I've been hurt, but I'm not convinced that was the right thing to do, and I'm actually evaluating that. CDM, is reverse mortgage not a thing anymore? Is it a viable income stream at later stage of retirement? So that's a great question, and I'm going to actually make a note to do some research and maybe do a video on reverse mortgages. I know that not too long ago they were more heavily regulated, and I've read that that's a good thing. But they're still a thing, absolutely. And they can be, my hunch is that the issue is going to be, one's going to be fees. That's going to be a big issue to focus on, which is generally one big issue anytime you're trying to buy some kind of instrument that's going to give you income, right? Or some kind of payment, whether it's an annuity. But I'll be honest, I'm not an expert on reverse mortgages, but I'll do some research and do a video on them. I can't pronounce the name, but I'll read the question. How to invest for a house deposit goal, 3 years, kids college, 7 years versus retirement. So you might not like this, but if I were going to buy a house in 3 years, I'd just put it in cash. I probably wouldn't invest it because unless I had a lot of flexibility on the 3 years. But the problem is, I think that you can lose a lot of money quickly, particularly with the markets today. And so if I knew I was going to spend it in 3 years, I personally wouldn't invest it. In terms of kids college, I did a video. So go to the channel and just go to the search function and search for 529. I did a video that talks about the 529 plan in Utah. I know you didn't ask me about 529 plans, and odds are you don't live in Utah. But they have a very good approach, I think, to investing, and they show you how it changes as your child gets closer and closer to college. So I think that's as good a starting point as any, and you'll find some, I think, um, good information there. Double Dog wants to know what's my take on the deer strike. So, all right, you asked, so I'm going to answer it. So I used to invest in Deere for a short period of time. I don't even remember why I got out of it. I think Deere is a good company. In fact, I probably wish I hadn't sold it. But I don't know if I gave it to charity. I can't remember. I may have donated it to charity is probably what I did. So the union approved the package, right? I mean, this was a negotiated deal. The union was all for it, but the vote against it, I think, was 93%, something like that, of the workers. So big issues. And I think it has something to do with everyone having the same pension, I think. But I don't know the specifics. I know that the other terms of the negotiated deal, I think, were pretty good for the employees. We're talking about factory workers making 60 and over so many years, I think going up to 72 grand. I mean, I remember Elizabeth Warren, I don't want to get into politics, but she railed on Deere. And that surprised me. Well, it didn't surprise me that she railed on Deere, I guess, because she's, that's just sort of her worldview. But I think, I don't at all think that the package that, again, the union approved was unreasonable. That doesn't mean it's right. It doesn't mean that the workers should accept it, and they've chosen not to. Fair enough. But I don't think it was like some evil corporation that was trying to, pull a fast one on the employees. From what I've read, Deere is going back to the table, and they're trying to work it out. But that's about the limit of my knowledge of it. All right. Salty's giving me the moves for this. Should I just make his moves and see if they're right? Queen takes rook. So the queen, so he wants this queen to take the rook. By the way, we'll get back to the questions, I promise. This will just be quick. So queen would take, right? Then he wants to do bishop check. I assume the queen would take it. And then he wants rook takes rook. Queen d4 check. Queen takes rook. I don't know, Salty. You've kind of lost me on this one. One approach would be to take the rook. Queen takes, and I can just take this rook. And a queen for two rooks is roughly even. One thing I always look at are checks, so I could check right away. That's interesting. If the queen takes, I just take, no. I take the queen, but then he'll take my rook check. We're gonna have to come back to that one. I don't know about queen takes rook, but I want to get to the other finance questions. We'll do the chess at the end. I thought we were at the end when I put it up there. All right. Oh, I see. Salty then said he has no clear answer. Yeah, I don't know. That's a tough one. How do I invest for short-term goals? Okay, we talked about that one. Can you summarize briefly your criteria for buying single stocks? I assume you asked that, Jeremy, after I kind of walked through what I do. So a couple of things. I'm a focus investor. I'm not going to have 20 companies. I've got 4 right now. To me, it's enough to handle that and understand them. And I am trying to beat the S&P 500. Why not? I mean, why not have that as a goal? And my view is my odds of doing that go down with each company I add. And I'm not looking for some diamond in the rough that no one's heard about, some small cap company that, that would take far too much time. And I don't know how effective I would be at that. So what I like to find are companies that are solid companies that I think are going to be around for a long time, kind of company I might buy and hold for decades, that for some reason are undervalued. It could be because it's 2008 and everything's undervalued because it just crashed. Or the industry is undervalued, or it may not be undervalued, but is valued at a certain level because of the current environment. So banking, for example, where, interest rates are so low. By the way, banks make money a lot of different ways, not just by lending money. But those that rely a lot on that kind of income, like Bank of America, I thought, well, I don't know when it's going to change, but I know it's going to change, and I'm happy to sit tight while we work through the economy. And I like companies with high margins, high cash flow, like an Apple. I mean, it's just they're minting money. I mean, it's just ridiculous. But they're richly valued now. I've not been buying more Apple. They're I marvel at the sort of Wall Street managers and pundits that say, all you got to go all in Apple. I'm not saying that wouldn't be a mistake. It's just that I don't get that excited about Apple at its current values. I'm not selling. But that's basically about it. Now, sometimes I'll sort of do more analysis, like a cash flow, like I described, but I haven't done that in a while. I didn't feel I needed to do that for Bank of America or Wells Fargo. So that's about it. I mean, it's not fancy. I wish I could tell you I had some neat formula and I could sell it to you. I got nothing. All right, this question says, Rob, sorry I joined late, no worries. What do you think about Fidelity Go and Fidelity NASDAQ Composite? Well, I have no idea what they are. Well, let's figure it out together. Oh, Fidelity Go is the robo-advisor. You have aggressive growth. Is aggressive growth one of their portfolios? It must be. Okay. So I haven't even looked at Fidelity Go before. But yeah, it looks like it's basically an investment advisor, a robo-advisor, and you can pick your portfolio. So he said he wanted to know about aggressive growth. So I guess it's this one. And I don't know what funds they use to implement it, but that seems perfectly reasonable to me for a long-term investor. 15% bonds, I could see someone saying they don't want that much, but I think this falls within a range of reasonable. Yeah. And that's an important, I want to say this, that's an important place to get to as an investor. I used to want to dial in my asset allocation to ridiculous levels. And after you invest long enough, you're like, yeah, it doesn't really matter that much. It just doesn't. I mean, there's dozens and dozens of reasonable asset allocations and reasonable funds to use to implement it. And when I started writing about investing and the podcast, part of me said, that's not what you need to do, Rob. You need to say, this is the answer. This is the only way to go. And in some ways, that would probably be appealing to a lot of people. That's what Dave does, right? This is the way you fix your finances. Do this, then do that. And I think a lot of people need that. Frankly, I can see why that would appeal to a lot of people. It's just not who I am, and it's not how I think. At least about money. When I hurt my back was really bothering me. I've told this story, and I started going to a gym here, Underground Athlete in Northern Virginia, in 2010 or 11. I needed a Dave Ramsey of fitness. I didn't want someone to say, well, you could do this, you could do that. No, I was like, tell me what to do, and I'll do it. Now, today, that's not what I want for fitness. I don't need that level of guidance. So I get it that some people with money want that level of guidance. But in my view, for me, I've come to the point where I recognize there's a lot of reasonable approaches to achieving financial freedom. So back to your question. Yeah, I think that's a reasonable approach. Let's see here. You asked me, and Fidelity NASDAQ Composite. Let me look that up. Fidelity NASDAQ Composite Index. So I wonder if this is going to be what this follows. Well, I mean, the problem with answering this question is this fund could be perfectly fine in the context of an overall portfolio. It kind of reminds me of the QQQ. I don't know if I assume it's not the same, following the same NASDAQ 100, but I don't actually know. But it's obviously a tech-heavy growth fund. The only thing I'll say about this is these types of funds have done extremely well, as you can see right across here, 10 years, it's unbelievable. And the only thing I would say is that's not going to continue. That will stop and it will have bad years. I don't know when. Van Mans asks, how do you feel about early retirement? How practical is it? What percentage would you look for in a Monte Carlo simulation? Well, I sort of kind of retired early, then didn't, then kind of did, and then I don't know what I am now. The way I look at it, what I kind of focus on is not early retirement, but early financial freedom. I define it generally as having 25 times your annual expenses. I probably wouldn't be comfortable actually retiring with zero other income with 25% of my annual expenses, particularly if I were, 40, 50s. I am in my 50s. But I think that would certainly be at a level where you had pretty good financial freedom. And there's a Charlie Munger quote. I won't get it perfectly right, but it was basically he wasn't trying to achieve wealth. He was trying to achieve independence, freedom. And that's what I was trying to achieve and did achieve. And to think of all the things I could be doing right now, I'm on live YouTube Q&A. In terms of Monte Carlo simulations, you've got to think about what the inputs are that go into the simulation. And so it's hard to say there's one percentage of success that would work. I think some of them are at 80%, some of them are at 90. What I would probably do is look at several. I would use personal capital. I would use new retirement. I might use on trajectory. These are different tools that we've talked about. There's some free ones. Well, personal capital is free, but there's some other free ones. But I would also say that if you're doing this analysis and it's seems to be right on the, kind of should succeed, but maybe not, I would be uncomfortable retiring early at that level unless I had other sources of income that I was going to draw on, a blog or, could, I guess, part-time work. But it sounds like you just want early retirement. I would be very uncomfortable retiring early, like 40s or 50s, let's say, with 25x my annual expenses. And I can say that regardless of what any Monte Carlo simulation tells me. Hope that helps. So evidence-based wealth asks a question. It says, thoughts about the rules changing on provisional income to include Roth distribution in the future. Provisional income already includes tax-exempt interest. I don't know a thing about those rules changing. So I don't know. I'll make a note. I'll look into it. It's not an issue I follow. Bob says, he says, Ray, where money has come from, that I made this comment, there's 2.5 trillion in crypto, where did it come from? He says, say a stock with a market cap of 1 trillion. If the next single share doubles in price, isn't the value now 2 trillion? If the next single share doubles in price. Yeah, I don't think it quite works that way. I mean, certainly if the value of all the shares, if it's trading at something 2x what it was, but I mean, you're saying if someone decided to buy Apple and through some trade paid twice what its current price is, wouldn't that then reprice all of Apple at 2x? I don't think so. I don't know. First of all, I don't know how that would happen in a regulated liquid market. It's an interesting question because I don't know why I'm looking up to think, but that's what I'm doing. That's what they say in deposition training. They say if the witness you're questioning looks up, they're thinking. If they look down, they're figuring out how to lie. So I'll look up. For investments, now I'm looking down. For investments that aren't very liquid, and there's very few shares exchanged, you can have manipulation for sure. Absolutely. But like not for like a legitimate, for Apple, that's not going to happen. For Bitcoin with $1 trillion valuation or more, that's right now fairly liquid. No, I don't think it's possible. All right, Salty, I see your thoughts on the chess puzzle. We'll come back to it, I promise. Rob, you need a sports doctor. Well, I do have a sports physical therapist. I haven't had to see her in a while. She's phenomenal. What are your thoughts on target date funds? We're in our 30s and have some rollover IRAs from previous jobs. We're currently using them to factor some bonds in our portfolio. I think target date funds are excellent if you get the right ones. And in fact, I've got a video planned for what I think are the best or some of the best target date funds. But you don't have to wait for that. I'll show you because I did an article for Forbes on this very issue. Let me pull it up and I'll show it to you. Here we go. Here's the article. There I am, along with my editor, Ben. Hey, Ben, if you're watching, you're probably not. You're probably hard at work. So I did research and came up with what I think are some of the best target date funds. So you can check that out. And they are here. Fidelity's got one. Fidelity has, by the way, both an index-based series of target date retirement funds, and that's what this one is. They also have a different one that's actively managed. So I picked this one. Of course, Vanguard, we just use the 2060 funds, but obviously they have all the different years. Vanguard's got a good one. State Street actually had the highest returns, as I recall, for 3 and 5 years. American funds, they have a decent target date retirement fund. I don't remember about the loads and do you have to use an advisor to buy them? And you see some of the others. By the way, I did include this one. I think we talked about it because down below there's text, but in any event, this is you can see the expense ratio is higher. This is their, I guess you call it actively managed version. But we included it because, the returns have been pretty strong. And so even then, these are on an after fee basis. And then T. Rowe Price has a good one. I'm sure there are other good ones. But yeah, so you can check that out. I've done some other stuff for them, like best ESG funds. I'm going to do some videos on all of that. Vinyl says, in 2009, we found out what happens when all stockholders try to sell at once. Well, we found out in 2020 too, right? Of course, they quickly reversed course. Salty wants to know if I actually play any sports. I don't anymore, really. I cycle, but that's not it's a sport, but I don't think that would classify as playing a sport. I used to play racquetball. I played a lot of racquetball in law school. Pick up basketball. I used to play golf. I belong to the club that's now Trump International on the Potomac. When I belonged to it, it was Lowe's Island. Great club, 2 different golf courses. And it's like, Rob, that was like the dumbest purchase you've ever made in your life. I joined the club, but all my friends played at other places, so I went and played with them. Yeah. All right, here's another question. Thanks, Rob. We currently are with Schwab and have a target date fund set a little later to skew it aggressive. So, and that's a good point for folks. What's that mean? So let's say you plan to retire in 2060. That's 40 years from now. Or whatever year. That doesn't mean you have to, and you want to invest in a target date retirement fund, you don't have to pick a fund that matches the year you plan to retire. You could say, I want one with more bonds in it than what the 2060 fund has. The 2060 fund, I'm guessing most of them are around 90-10. So maybe you invest in a 2040 fund. Or you're retiring in 2040, but you don't want that many bonds. So you invest in a 2055 fund, right? There's no target date retirement fund police that will come arrest you for investing in a fund that has a year that doesn't match your planned year of retirement. I will say this: once you get to near retirement, I think these funds get way too conservative. They go below 50% in equities. I should say, I think they get way too conservative for a lot of investors. So if you look at like a Vanguard 2015 fund, which someone who retired a few years ago might in theory own. Let me just make sure I can find this. I'll show it to you. Yeah. So this is from the Vanguard website. It's 31% stocks. That I don't know. That could be appropriate for some folks, but I think for a lot of folks, even in retirement, that's way, 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 way too conservative. So you've got to be mindful of that. I think in retirement and even near retirement, these target date retirement funds tend to lose their appeal. At least they do for me. Felix says, by the way, Rob, curious what you think of mixing international and US investments. And he's in, I guess, local bonds in Kenya are paying 10 to 12%, money market fund 10%, then add US stocks. Well, I mix international and US investments. I don't invest in bonds in Kenya. Maybe I should. There's a lot of folks who would say don't. The US markets just over the long term do better. And that's certainly true over certain periods of time. I'm just not, I just feel more comfortable having more diversity. Obviously, US companies do business all over the world. And a lot of the profits from the S&P 500 come from international business and deals and revenue. So S&P 500 has international exposure, but I feel more comfortable having international to some degree. It's not it's, I don't know, 20 to 25% of my stock portfolio, I think, roughly. That's just what I'm more comfortable with. But yeah, I think it makes a lot of sense. Neil wants to know, what is the average age of your audience? Seems like a lot of retirees weigh in. Well, I am old, Neil. I can actually tell you, let me see if I can show you this. This is sort of a retirement investing. Yeah, we let the young kids in, but let me see if I can show you some demographics. I'll pull this up on the screen in a second. Let me see, audience. Here we go. So most are in the United States, but 25% are outside the United States. That's what that says right there. Try to make it a little bigger for you. Most are men, but women are they're growing 11%. And yeah, here's the age distribution. So 12% are over 65. So you look at this, 20, 40, over 50% are 45 years of age or older. Yeah. But I like to say that 55 is the new, 52 and a half. Anyway. Bandman wants to know whether I think fewer young people are investing, and if so, how do we create more investors? Actually, I don't think that's true. I don't know. I don't have any data on it, but I think the Robinhoods of the world and the stock market surge, even crypto, has brought a lot of young people into investing. Now, I do get concerned that they're investing in ways that's more speculation than investing, and that when things turn, and they always do, I think we could lose a lot of them. I hope not. I hope they just say, okay, that didn't work out for me. For some of them, it will, right? We all know crypto has made some people wildly rich, but it's gonna hurt a lot of people too. And that's not because Bitcoin is bad. It's just when you have any investment that's fluctuating like it is, it's just going to create a lot of speculation, and there's going to be some winners, there's going to be some big losers, but I think we'll lose a lot of them. But yeah, I think there's actually been a lot more investors. So, all right. Neil says you don't look old. Neil, thank you. I'm wondering if your eyesight is going. I don't know. I had someone ask me if I was 74 years old. Really? Okay. All right. By the way, let's be nice. I think people are nice in the chat, but like depending on what words you use, I get this show hide thing that comes up. I can hide your comment if it's I'm not going to hide the comment I'm looking at, but just use nice words. Someone says, if someone followed Dave Ramsey's steps to the T, do you think they have a better chance at retirement, or is there anything you disagree with Dave's steps? So Dave's steps absolutely work. There's no doubt in my mind they work. Are there things about Dave's steps that I wouldn't follow? Sure. I'm not necessarily convinced that $1,000 as an emergency fund is enough, and then everything else goes at debt. That concerns me. One way I addressed that when I was getting out of debt was I had access to credit, like a home equity line of credit and credit cards, which he doesn't agree with either. I understand why he doesn't. Credit gets a lot of people in trouble, so I can't argue with him there at all. I agree with him. But for me, it didn't, and I was able to sort of rely on that and then throw money at some debt. The other thing that I don't agree with is pay all your non-mortgage debt before you invest. That to me is probably the biggest disagreement I have with Dave. And I understand he's trying to keep it simple and focused and get out of debt, and it makes sense, and it will work. But I got company employer matches. My money was growing. My debt was at low interest rates. A lot of it at 0% because I was using balance transfer cards. It wasn't credit card debt. I was able to transfer other debts over to balance transfer cards. So in any event, so I don't agree with that. And I'm a do-it-yourself investor. He's not a fan of that. So we don't agree with everything. I mean, but at a big picture, sort of avoid debt, do smart things with your money. I'm in complete agreement. And by the way, there's also this order that you pay off your debt. He says, pay off the smallest balance first. And there's good arguments for that. And if it works for you and it's working for you, keep doing it. I was more of two things: pay off high interest rate debt first, although I didn't have any, so that wasn't much of an issue. But I also looked at liquidity. I'd much rather pay off a line of credit card, home equity line of credit, than an installment loan like a student loan. Because if I ran into trouble, I could access that line of credit again. Now, that's a two-edged sword, because what some people do is they pay it off, they go back into debt, pay it off, and they go back into debt, and they can never seem to get out of debt. That wasn't our problem. Neil admitted he was nearsighted. All right, so I've gotten to the bottom. Yes, so we're going to go back for salty's sake and look at this chess puzzle. If I lose some of you in the chat, thank you for watching. I will look back at the chat for any more last-minute questions, but let's look at this. So my first thought was bishop check, right? Bishop here. When I just look at this puzzle, that's the first thing that my eyes are drawn to. And but I don't think that works, right? Well, for starters, you can just take it with this rook, and I don't see what I get out of it. I lose the bishop. Although I could take this rook. What if I just take the rook? What's the threat? Oh, what am I saying? You could take this rook down here. Okay, it's good to see. So yeah, if I move my bishop here, he takes with the queen. I could take with the queen, and it looks like I win this rook, but I don't, because he can take it with check. And I got to deal with that, and then you can take back the queen. I don't think that works. If I take the rook, he takes with the queen, and then I take this rook. I mean, I've got two rooks for the queen. Is there anything better? But I'd have to take this rook first, right? I can't take this rook, or he takes here with check. Although even if he did, I could drop this rook back. All right, let me go to the chat. Maybe you guys have an answer. Oh, and by the way, if you didn't come in at the beginning of the video and you want me to respond to a topic or question, make sure to put @ in my name, because it lights up orange. If I don't see the orange, I skip over it. So this one's kind of got me flummoxed. I've got to deal with this rook and queen, right? Because he's got discovered check as soon as he moves that rook. So I got to check him, I think. Of course, if I take this rook, he could actually bring this rook back, and it's discovered check. Oh no, because I could just take the queen. All right, enough of this chess puzzle. I'm taking that rook, and it's either going to be right or wrong. Bishop check. Salty wants a bishop check. I don't think that works. For starters, he could drop this rook back, and it's discovered check. But even he doesn't even need to do that. Can't he just take the bishop with the queen? I guess then I can't take this rook here because then he takes my queen. If he takes my queen first, I play rook takes rook check. He's got to deal with the check, and then I don't know. All right, Salty, you could be right. Oh, I got it wrong. All right, let's see if Salty was right. No, Salty wasn't right either. All right. I can't take. I could try that, maybe. Of course, I could always just take the bishop. That doesn't work because he's got discovered check. I got to deal with the discovered check. I could just take it and then drop back. Yeah. No, you don't drop back. Maybe you must enter. Well, no, you can just go here. Look at that. Bishop check. No, I can't be right. I guess I just take the bishop, right? No, you don't. All right, I need help. Oh, on the late questions. So if you want more questions that are on topic, put @RobBurger in the chat so that it lights up orange, and then I see that. And I will come back to it. I promise. Well, here, couldn't I just do that? Yeah, and then I can win the bishop. Oh no, I can't. Not yet. Boy, this is tricky. See, can't move my bishop here. It'll just check me. Well, I want to get back to the question. So we're going to do a hint on this one. So we move the rook, really? You don't go all the way down, do you? You sure do. Huh. That was a tough one. That's rated 2778. I think that's the first one I've missed since doing the chess problems for you guys, but that was embarrassing. I got to work on my game. So, Alan, I see your portfolio. 6% in each of the top 10 NASDAQ stocks. Okay, we can kind of visualize what that looks like. 10% in gold. 20% in gold and 20% in TLT, which I know I've looked at before, but can't remember what it is. Oh, it's just the 20-year Treasury. Well, it's funny. That's kind of got a Ray Dalio feel to it in my mind. I personally would be that portfolio would scare me to death. I think in some periods it probably does extremely well, but the high concentration in tech growth concerns me. 20% in gold concerns me, and 20% in 20-year and long-term treasuries right now concerns me. So that's an interesting portfolio. Again, it kind of reminds me of Ray Dalio, but I imagine over the right periods of time, it's done very well for you. Dave, I don't really have a recommended ratio of emerging versus developed. In the past, what I've done is had 20% of my portfolio in developed and 10% in emerging. I can't call that a recommendation. That's just what I've done. Vinyl says, you didn't see my question about authorized participants draining money out of ETFs. Nobody ever counts that expense. Okay, fair enough. I don't really know. That's not something I focused on. I guess I'm one of those folks that's never really counted that expense. Do you have any recommendations for an ETF that does sector rotations? I don't actually, because it's just not an approach I've invested in or followed. This is an interesting question. What do you think is best if you have all three options, 401k, HSA, and IRA? Well, they serve different purposes, at least the HSA does. So the HSA, from a tax perspective, is probably the best, right? Because you get the triple tax advantage. You get a deduction with the contributions. It grows tax free, and if you use it for qualified medical expenses at any time, now or 50 years from now, they're tax free. And once you turn 65, you can take money out for other reasons without a penalty. You would pay ordinary income tax if you did that. Of course, you have to have a high deductible healthcare plan, but I like it, HSAs, a lot. We have them. But they're very different than 401ks and IRAs. So I shouldn't say they're very different, but they're different, and they serve different purposes. If you're saving for retirement, to me, the 401k or IRA makes more sense initially. You can add an HSA for retirement purposes along with them potentially, but I don't know that I would substitute an HSA for an IRA or 401k, in part because you get hit with a 10% penalty up until you're 65 if you don't use it for qualified medical expenses. Take it out for some other reason. Between a 401k and an IRA, I mean, they're both good. They're a little different. With a 401k, you open it up through your employer, which makes it a heck of a lot easier, but you're limited typically to the investment options in your employer's plan. Often, though, they're good, though. So, if they're good, then that's not a big deal. It comes right out of your paycheck. It's easy, right? With an IRA, you have to open it yourself. Again, not a big deal. You could use Fidelity. You could use Betterment. You could use Vanguard, Schwab, M1 Finance. And you have to make the contributions yourself. And then assuming that they're deductible, you have to then deduct them from, make sure they're factored in on your income tax. With a 401k, it's all reflected in your W-2. So 401k is a lot easier. But, they're both good, and they both have advantages and disadvantages. So if you're going to ever want to use the money early and avoid the penalty, the rules are different. So keep that in mind. Like you can use an IRA as a first-time home buyer, there are limits, but as a first-time home buyer for qualified education expenses, you can't do that with a 401k. And double check all of this. I'm just doing this off the top of my head. Much like I tried to solve that chess puzzle a minute ago. With a 401k, you can often do a loan. Not that that's necessarily a good thing, but you can borrow from your own 401k in most cases. There are limits, and I don't always think it's a good idea, but you can't do that with an IRA. At what point would you buy crypto? Do you think it will remain as an alternative stock market? I don't know that I would ever buy crypto. I bought some Ethereum a few months ago and just sold it the next day. At the time, my thought was, I'm sort of interested in DeFi, and maybe I'll just own a couple of Ethereum just to kind of have some skin in the game and give me a reason to follow it. And then after like a day or two, I thought, this is stupid. You can, if you've timed it right, you can obviously make a fortune on crypto. I really think crypto generally, and Bitcoin in particular, is going to go down as one of the biggest follies we've ever experienced. If you think about it, we've really created something out of thin air. We've done it at an extraordinary cost of resources. And it's something that is, at least right now, effectively useless. I know in theory you can buy stuff with it. That's not why people are trading. It's not why it's trading at whatever. 66 grand? I don't know. What's the Bitcoin price today? That's down 63,000. Oh my goodness, it's a fire sale. And right now it's pure speculation. So I mean, like if someone says to me, Rob, I'm speculating, I could win, lose, who knows? I get it. And if you've got some amount of money you want to do that with, that's you get no comments from me at all. It's the people, and I sort of debate with these folks that say, oh no, Rob, you're missing the whole point. You don't get it. Fiat currency, they always use the word fiat. It's like, okay, we could just call it US dollars, okay, or euros. I mean, okay, but but there's nothing back in it. Well, there's nothing back in Bitcoin. Yeah, but it's limited in number. Well, there's a lot of things that are limited in number. That doesn't tell you what their value should be. Can you think of anything else that's got a market value of $2.5 trillion in our world that's basically useless right now? I know in theory we could use it as currency, but we don't, not really. You can look at other commodities and say, well, commodities don't have any intrinsic value, right? But I mean, we do a lot of useful things with wheat and corn and oil. Even gold, which is a store of value, and some people describe Bitcoin as sort of the digital gold. But even gold, they mine about 2,500 tons a year. I think they estimate there's about 50,000 tons left to be mined. So it's limited, right? There's not an unlimited amount of gold, at least not here on Earth. And they mine about 2,500 tons, give or take. About half of it's actually used for stuff. Jewelry for the most part, but there's some industrial applications. And then, central banks buy some of it, and then, of course, investors do. But it has some uses. But we're basically just trading on pure speculation for something that doesn't generate any income or cash flow. It's not like a Berkshire or an Apple that's making money, or a lemonade stand. And it doesn't serve, it's not useful in any way. Some say, well, it'll become digital gold. And here's the thing, if it does, and maybe it will, the people that saw that ahead of time and bought early while it was, expanding like it has, and being adopted as digital gold, will have and will make a fortune. There's no question about it. If it actually ever becomes digital gold, though, it'll be as bad an investment as gold is, which is basically, long term, it basically goes up by the rate of inflation. That's what gold does, with a lot of volatility from time to time mixed in. I've had people say, why in the world would you own cash? Gold keeps its value. I'm like, I don't. I have as little cash as I need. I invest in stocks. Why wouldn't you do that? I don't know. That's my take. And I know it's extremely unpopular. But really, I think things like Bitcoin will go down as the biggest folly financial folly we've ever seen. Evidence-based wealth says gold and U.S. stocks have a negative correlation that grows with holding period, which, by the way, would be, from a diversification, be a good thing, right? And there are certainly portfolios that we've looked at that include gold. Ray Dalio's is one that's have done well. So there's certainly an argument for gold in that theory. I've read some research that says that that's not actually a great inflation hedge, but it is a good hedge when real rates are low, meaning after inflation. But Alan says rebalance quarterly. I guess that's a question. That's certainly a reasonable approach. It's one of many. Alan says you can stockpile HSA expenses from earlier years and let the HSA earn the expense. Yeah, so that's right. So like if I have a medical expense for $100 this year, I can just hold on to that receipt and then sort of cash it in, withdraw that $100 from HSA 25 years from now. So yeah, you could take that approach with the HSA, and we have some saved expenses. I tend to just save anything that we have that's sort of bigger, but Salty's still talking about the chess puzzle. I know that was a tough one. Okay, so Charles says, I'm not really a crypto fan either, but I'm confused by the useless point. Aren't all securities only as useful as what someone else will buy it for? It's a great question. So let's imagine you have two choices. You can own literally all the Bitcoin. What is it, 22 million? Is that the number? Whatever. I know it hasn't all been mined, but you can own all the Bitcoin that exists today and that will exist in the future. They're all yours. Congratulations. Or you can own all of the shares of Berkshire Hathaway, which doesn't pay a dividend, but you're the owner now. Which one would you take? Now, by the way, Bitcoin is worth a lot more, I think. Yeah, it's over $1 trillion. Berkshire's not over. Berkshire's got a market cap of like 500 billion, I'd say. Anyway, which would you take? With one caveat, you can never sell either. And by sell, I mean use it to buy something else, you exchange it for cash, exchange it for whatever. Which one would you own? And the answer, I think, is obvious. I think it's Berkshire, right? Because while you could never sell it, you'd get billions in cash every year, right? Because it's a company that's making money. And you're the only owner. So you can invest as much of that back into the company as you want. And unlike Warren Buffett, you can take a dividend. So that's sort of a trick question, I think, but I think there's only one reasonable answer to that question. And I know that seems like it's kind of like a goofy question, and in a way it is, but it underscores the fact that an ownership of Berkshire, you're not just owning a piece of paper. You're owning a portion of an actual real business that's doing real stuff that's useful to people, and as a result, generating money. The same could be true, I think, with most commodities, right? Oil has many uses. So does wheat and corn and silver. And so there's uses to put them to. But right now, Bitcoin, as a practical matter, isn't used for anything. Okay, that's my take anyway. Alan says something like 90% of gold ever mined simply sits in a bank vault. Yeah, that's sort of Warren Buffett's point. He goes, why invest in something that you spend a fortune digging up in Africa, shipping it over here, and then burying it in the ground? I mean, you could make the case for some gold in a diversified portfolio, though. I mean, just historically. What are your thoughts on VC? What time is it? Okay. We're going to bring this to an end soon. It's been 2 hours, and I'm tired. I'm old, remember. What are your thoughts on VCLT? Well, I don't know what VCLT is, so I have no thoughts on VCLT. We're going to find out. Oh, long-term corporate bonds. Well, so it's a Vanguard long-term corporate bond index. I mean, the issue again is the long-term part. If we look at it, I can pull it up on the screen in Morningstar. Maybe. Yeah, here we go. So it's got a yield of roughly 3%. That's both because it's a corporate bond fund and it's long-term. So its duration, I don't know what its duration is going to be, 10 to 15 years maybe? Yeah, 15 years. And its credit quality is investment grade, which means it's BBB and above. So, risk of default is not zero, but it's probably a fairly stable fund, at least in terms of credit risk. The issue is what's going to happen to this fund when interest rates start to go up, if you believe that's going to happen. Well, if an increase of 1%, you'd see the fund drop by roughly 15%. That would be my concern with it, given low interest rates today. Now, you may think, interest rates aren't going to go up anytime soon, or they might even go down. Yeah, Charles says, I don't think you guys don't like my question about Berkshire versus Bitcoin. People would not buy securities that they are forbidden to sell. Well, that's true, of course. But it's not at all uncommon for someone to own a business and own it their entire life and pass it on to their children. And owning stock it's different because you're a minority shareholder. You can't control I can't call up Tim Cook and say, pay a higher dividend. I guess I could try, but in any event, one of the things that Warren Buffett talks about is when we buy stocks, we should evaluate it and treat it and think about it like we're buying part of a company, because that's what we're doing. And I think thinking about it that way will make, I certainly think it makes me a better investor. And so, people do own companies for generations, and stock for that matter for generations. I mean, the Ford family, I actually don't know what their portfolio looks like in what I'm sure is a large family office, but they're obviously still involved in Ford. And you can do that with an asset that's generating income, right? That's doing something. And that's my general concern with commodities in general. But when you get to something like Bitcoin, the other interesting thing about Bitcoin, people love to say that it's limited, and it is, but not in the same way that gold is, for example, or that trading cards are, or art, right? I mean, if you've got a Monet, there may be a few other Monets out there, but the one you've got, they ain't going to make more of them, at least not, they can make copies. Same thing with a baseball card, maybe an old one, and there's only 3 left, and the one you have is in the best condition or whatever. We can make as many Bitcoin as we want. We can't mine more than the limit for Bitcoin itself, but we can make identical crypto. I mean, right? And or other very similar crypto. And of course, there are, I don't even know how many different coins there are now, thousands. Now, someone would say, well, Robbie, yeah, but Bitcoin was first and it gets that first mover advantage. And that's why Bitcoin is the largest. And I get that. It is. You're right. There's no question. But if we ever get to the point of trying to go from let's invest in Bitcoin because we might get rich, let's be honest, that's what we're doing right now, to how are we going to actually use crypto in a functional way? Bitcoin will, I mean, who cares? It doesn't have to be Bitcoin. And in fact, the governments are likely going to move in and regulate it and dictate what we end up using. And it's easy to just create another one, right? It's maybe easy is a little strong, but obviously people are doing it. I mean, we go to Coinbase and you just see lists and lists of crypto. Anyway. All right, it's now 1:01, so I'm going to call it a day. I appreciate you guys hanging in there and watching and supporting the channel. It means a lot to me. And I'm happy that you disagree with me on some things. That's great. You guys have been wonderful. And that's all I got for today. So like I said, I'm going to probably try to do this every Thursday at 11, but the day could change, the time could change. I'll try to give as much notice by scheduling the live stream ahead of time. So if you've subscribed to the channel and you get notifications, you'll see when that happens. So there you go. All right, I'm going to read 2 more comments. Great live show. Thank you. Appreciate it, Charles. And cryptocurrency gives money mobility. Absolutely, absolutely it does. It's not the only way to do it, by the way. But that is important. Whether that it doesn't require Bitcoin, of course, right? But absolutely it does. And that's extremely important in a lot of places in the world. So, all right, gang, have a great week. Until next time, remember, the best thing money can buy is financial freedom. I was about to click in the stream and DC said, you did not answer my question. Well, what was your question, DC? Yeah, I'm a good guy. I'll hang out. Norse says, was my comments cut off? I don't know. I didn't delete any comments. I can tell you that. Well, maybe DC signed off. All right, gang. So Sean asks an asset location question. How should you treat taxable accounts and non-taxable accounts when you're investing in stocks and bonds? Well, generally, you want to put tax-efficient investments in a taxable account. So generally, they've said like a stock index fund would be better in a taxable account than a bond index fund because bonds throw off income every year in the form of interest and it's taxed as ordinary income. There is a flip side to that. Right now, bonds aren't paying much, so it's not like they're going to generate that much in taxes. The other thing to consider is that for Roth retirement accounts, as I've said before, you want to get those, you want those to become as fat as a tick, which is you want that to become as big, as possible because it's tax-free when you retire. And so you definitely want investments with a high expected return in a Roth. The other thing to factor in is rebalancing. You want to be able to rebalance. And so I never want to isolate one asset class just in a taxable account. I want to have at least some of it, if I can, in a retirement account so I can buy and sell without triggering taxes. But that's the basic idea. So like you really don't want to include a REIT, for example, in a taxable account because it throws off a lot of income every year that's taxed as ordinary income. You don't want to put a muni fund in a retirement account because it gives you tax advantages that would be wasted if they were in a retirement account. So I hope that helps. Okay, so yeah, that was DC's question. Thank you. Appreciate it. I think I've answered it. I hope. And if I've missed you, I'm sorry. We'll catch you next week. So I'm going to say this one more time. Until next time, remember, the best thing money can buy is financial freedom. Be good.